Hello, everyone. Good day to you wherever you are. We've had a couple of technical troubles, so we're going to get started again. Apologies to those who have heard the introduction a second time, but I'll get through it and we'll get you to the interesting part very quickly. My name is Robert Youngman. I'm team leader for green finance and investment in the OECD's Environment Directorate. I'd like to welcome you today to OECD Green Talks Live, where we will discuss infrastructure investment. In particular, we will discuss the report Green Infrastructure in the Decade for Delivery, Assessing Institutional Investment. This report, which was published in October during the OECD's annual Forum on Green Finance and Investment, was authored by my colleagues in the Green Finance team, Dirk Rutgers and Ayush Tandon. By way of background and introduction, one strand of work on green finance and investment at the OECD focuses on policies, institutions, and instruments to mobilize investment for the low carbon and sustainable transition. As part of this work, we have focused on infrastructure investment by institutional investors. We have helped draw attention to the potentially central role of institutional investors, pension funds, insurance companies, sovereign wealth funds in bridging the massive investment gap for sustainable infrastructure. Encouragingly, in the last 2 years, some of these actors have stepped up their activity. Institutional investors are increasingly making commitments to invest in sustainable infrastructure and align their portfolios. Today, we have invited representatives of the Danish government and the Institutional Investors Group on Climate Change to provide short interventions to share information on these activities. That said, there is very far to go. But how much can we expect institutional investors will invest in sustainable infrastructure? The report answers some important questions that had long been unanswered. For the first time, the new report and the accompanying Data Explorer website offers granular data on infrastructure investment, starting with headline numbers, but going down to specific estimates by investor, instrument, and infrastructure type and region. In addition, the report provides a first of its kind estimate of what we call investable assets under management. This is the total regulatory cap on institutional investment in infrastructure. We think this estimate provides a better benchmark measuring current infrastructure investment against what is actually possible rather than total AUM. Some brief housekeeping items before we get started. First, the agenda. Dirk and Ayush will start with a presentation of their report and the Data Explorer tool, covering about 20 minutes. Then we will hear from two discussants, Hannah Jersild with the Danish Ministry of Climate, Energy and Utilities, and Daisy Streetfield with the Institutional Investors Group on Climate Change. We will then open up the discussion for Q&A. If you would like to ask a question to our speakers, you can at any point starting now. Enter them at the Q&A tab at the bottom of your screen. Please save this for specific substantive questions rather than comments or other messages. I'll review the questions and direct as many of them as time permits to our speakers. Now, finally, let me introduce Dirk Rutgers and Ayush Tandon. Both are policy analysts in the Green Finance team in the OECD's Environment Directorate. Ayush, Dirk, the floor is yours.
Thanks, Rob, and thank you everyone for joining us, and apologies again for the technical glitch at our end. So we conceived this report with three ambitions. The first was to provide a robust estimate of institutional investment in infrastructure, particularly green infrastructure. The second was to establish a baseline for future tracking and measuring progress. The third was to provide a solid evidence base to inform investment mobilization strategies and product development going forward. So for the next 20 minutes, Dirk and I are going to walk you through the findings of our recent analysis. We've structured the talk today around three guiding questions. The first is to do with anchoring expectations. We ask ourselves, how much can institutional investors actually invest in infrastructure? The second is to do with the current state of play. How much do these investors currently hold in infrastructure assets? Through which instruments, in which geographies, in which sectors, and so on. And the third is around action and outlook. Knowing what we know now, what can we do to accelerate and scale up private investment in green infrastructure? So on to the first one. In OECD and G20 countries, institutional investors like pension funds, sovereign wealth funds, and insurance companies preside over upwards of $65 trillion in capital. Very often, a judgment of progress or lack thereof involves a comparison of investment activity with the entire assets under management. However, in many jurisdictions, pension funds and insurance companies are subject by regulation to quantitative limits by asset class in their investment, which means that even though they preside over a large pool of capital, only a subset thereof is available and can be legally allocated towards infrastructure. We call this subset the investable AUM, and believe and propose this as a more accurate benchmark against which to measure progress. So our data shows that under current regulatory limits through investments by unlisted funds and direct project level equity and debt, pension funds and insurance companies in OECD G20 countries can allocate a maximum of $11.4 trillion towards infrastructure. This is, of course, an upper limit. But what this concept helps us do is firmly anchor expectations. By clearly delineating the role that institutional investors can play in critical infrastructure development, it guides policymaking and help us recalibrate our mobilization efforts. Now, even before the pandemic, there was unequivocal consensus that the ballooning investment deficit in global infrastructure cannot be plugged by the government and public sector alone. The pandemic has only exacerbated the need for private investment. However, as we enter this decade for delivery, critical for our fight against climate change and achieving the SDGs, it is imperative that our mobilization effort and any mobilization strategy be guided by robust empirical data and a clear, nuanced understanding of the current investment landscape. To that effect, our report provides a comprehensive empirical mapping of institutional investment in infrastructure in OECD G20 countries. We do this across 7 sectors: energy, transport, social, waste management, water supply, and telecommunications. The report also provides a classification and mapping of green infrastructure investment holdings and a view of cross-border trends and investment. With that, I would like to switch to our online data tool to walk you through some of the key messages and implications of this exercise. What you see on your screen now is a snapshot of infrastructure holdings by institutional investors domiciled in OECD G20 countries. What this chart does is construct the economic relationship between investors, physical assets, and financial instruments. It tracks the origin of investment on one side, all the way by investor type, all the way to the destination of the investment by sector. Our sectoral maps provide a further breakdown at a level. While this chart, but at the very outset, this chart provides a wealth of information. While it captures and communicates a lot of insights and data, I would like to highlight on a key difference between the approaches of asset managers and asset owners. So we see that asset owners like pension funds, insurance companies, and sovereign wealth funds exhibit a strong preference towards illiquidity, allocating the lion's share of their assets through unlisted funds, project level equity, and project level debt. This is possibly motivated by an illiquidity premium. In contrast, asset managers channel the vast majority of their infrastructure investments through liquid products like REITs, yielding companies, master limited partnerships. We see this trend reflected and trickled down all the way to the landscape of green infrastructure. I apologize, this is taking a little bit of time to load. Sorry. So as I was mentioning, we see this difference between liquidity and choice of instrument trickle down all the way to the landscape of green infrastructure. And this insight is choice of instrument and preference for liquidity has critical implications for the design of policy and mobilization efforts. Now here, once again, we see a lot of data and we get a wealth of information. But what I'm going to do now before passing the baton to Dirk is take you through some of the key trends by investor type. So we see for pension funds that over 90% of the investments are made through direct equity and unlisted funds. Data on pension fund commitments and unlisted funds shows that there's been a shift in the recent years towards riskier strategies. This is in keeping with the overall market drift towards riskier infrastructure strategies. Now, one important implication of this trend going forward is a potentially higher availability of institutional capital for construction stage new projects. Pension funds have currently allocated about 25% of their infrastructure investments to green assets. A closer look at this data reveals that annual direct equity investment by pension funds in non-green assets consistently exceeds that in green assets. This is driven by investment in natural resources infrastructure and buildings, primarily by private pension funds. On the debt side, we see the lion's share of direct debt being extended by pension funds to renewable energy projects. Now, our data shows that the vast majority of infrastructure allocations in the insurance sector originated by life insurance companies. We see 81% of current investment by insurers being channeled through unlisted funds and direct equity. About 38% of total insurance company investments are allocated to green assets. And our data shows that in terms of direct equity provision by insurance companies, this has been on a steady upward trajectory towards wind and solar. Now, as you can see, sovereign wealth funds play a relatively modest role in the larger landscape compared to pension funds and insurance companies. We attribute this to two factors. The first can be explained by a lack of disclosure around the portfolios of sovereign wealth funds. The second is to do with the fact that there are less a number of sovereign wealth funds than pension funds and insurance companies in the OECD and G20 countries, which is to say that the investable AUM of sovereign wealth funds is much lower than that of other institutional investors. Having said that, it is noteworthy that the share of sovereign wealth fund investment in non-green assets through unlisted funds has been steadily increasing in recent years. This is driven by investment in fossil fuel projects and natural resources infrastructure. Now, in contrast, we see that asset managers, they manage capital on behalf of a much wider set of clients that have different investment strategies and risk-return preferences than longer-term investors like defined benefit plans and life insurance companies. So we see that over 80% of the green infrastructure investment by asset managers is affected through yieldcos. Now, this is a powerful insight. In context of upscaling private investment for green infrastructure, it is important to acknowledge this liquidity preference. So in the context of upscaling this investment, our data and our research advocates for a leading role for financial policy and innovation, advocating for a rise and uptake of structured products and securitized vehicles. And with that, I would like to pass the baton on to Dirk.
Okay, thank you, Ayush. And thank you all for joining this webinar, the Green Talk. As Ayush showed, there's lots of granularity in this data, and we've used this now to look into the types of investors and the products. But there's one level at which one angle of the data that we haven't covered yet, which is the cross-border investments. And I would like to take a look at the cross-border investments of institutional investors in all types of infrastructure, if we can. Ayush, if you could click there. Thank you. And as a first example, let's go to the EU, and I would like you to focus on the left side of what you see on your screen. This is a chart diagram tracking all infrastructure investment by institutional investors in OECD and G20 countries. And basically the outer ring of this chart diagram is showing you the piece of the pie of that is invested in that particular regions of the overall investments within the scope of our countries. So for example, if you would hover over the ring, you would see that in Europe there are 180 or 179 billion invested into. And the links inside this ring show you which institutional investors from which region invest in infrastructure in which region. So what Ayush is hovering over right now shows you the aggregate of North American investors investing in European investment in infrastructure and vice versa. And what you clearly can see here is that there's a home region bias. So this is the large link that's going from that piece of the pie to itself. In Europe, that one. And you can see that also for the other countries, although they are shaded, there's a large home region bias, and this is not really surprising. This is something we see with all kinds of investment, that there's a domestic bias, and this is actually where this is coming from. We check the data, of course. But what you also can see is that, there's this strong link, for example, between North America and Europe. So showing that one mature market also, or primarily when investing outside, invests in another mature market. But when you go to emerging countries, you of course also see that home bias, and then the next ranked investments also are going to, from institutional investors in infrastructure outside of that region, are also going to mature markets, and to a larger extent even compared to the home region investments. And just as a point that I want to make here on Europe still, is that investment behavior in Europe, and to a similar extent also North America, are driven by pension funds. So the type of investor that's most active here are pension funds, which is largely driven in Europe by UK, Danish, and Dutch pension funds. Whereas in Asia, for example, if we can go to that example, just to highlight that a little bit more, we can see that the active investors really here are sovereign wealth funds, and in particular, that's the Chinese sovereign wealth fund, and insurers, and that's particularly Korean insurance companies. So as I said, this is all infrastructure. So it's basically the region angle of the pictures or underlying the same data that Ayush just showed you. And now, like Ayush just did as well, I want to go to the cross-border diagram that only shows investment in green infrastructure. Also, as a first example, looking at Europe. And what you see here is a slightly different view. On the left side, in the four colors, you see, and there's the fourth color, here's the sovereign wealth fund. It's only a small sliver, but you see the four types of investors investing European investors that are investing in infrastructure. And you can see on the right side here, where you see in green the infrastructure that's invested in by these European investors, and each of these parts of the pie, of the part of the ring, each of these pieces is a region. And this large region you see here is, of course, these are European investors, so that's the European region or European infrastructure invested in. And what's noteworthy here is that this part is in relation much larger than it was for all infrastructure, i.e. in green infrastructure, we see an even larger home bias, a home region bias, and therefore also domestic bias of investors. So for green infrastructure, this is even exacerbated, opposite in a large need in emerging countries. And I'd like to go to the slides, back to the slides now, to come to some policy conclusions that we draw from all this data. And you see here this rather complex analytical framework, which I will walk you through in just 1 second. But before that, I just want to say what we're looking at here are policies, and particularly policy levers, that are relevant for mobilizing institutional investment. Obviously, this is all embedded in a larger policy framework, which we also for which we also list policies in the report. But these policies go way beyond the interests of the interest in institutional investors. And I would refer you, for example, to our report, Investing in Climate, Investing in Growth, or Financing Climate Futures, if you want to look at the larger picture of climate policies and investment policies. In particular for institutional investors, so to come back to this slide and this analytical framework, we looked at basically 3 regions of levers, whereas the one on the right side here that is shown non-shaded, that's the strengthening the supply side of projects. And in particular, it became clear to us, not just from the data, but also from interviews with investors, that infrastructure planning and development is key to mobilizing institutional investment. When we talked to institutional investor representatives, what we heard time and time again, you all will have heard that before, I think, that there's a pipeline of bankable projects that's missing. There's a deal flow that's missing. Now, I won't go into too much detail here on what can be done on infrastructure planning and development. We have 2018 report on developing robust project pipelines that outlines in detail. Our report outlines in detail how you do that. Our report has some of these details, but I would still refer you to that 2018 report if you want to know the criteria and how to set up infrastructure planning and development, how to set up that pipeline. In particular, though, what I want to point to here is the role of risk mitigants that can help establish these markets or create these markets. That could be one important lever, especially for mobilizing investments in regions and particularly emerging markets where projects are fraught with risk, to take out the risk, so mobilize institutional investors. And there's a role there for governments, or rather for public financial institutions like development banks and particularly MDBs, to step in here and de-risk projects so that a deal flow can happen. Could you click, Ayush? And this deal flow would, or this increased pipeline of bankable projects would just generally help institutional investors justify going into this area of investment, going into new technologies, or to institutional investors. They sometimes are new technologies that are needed for green infrastructure, or they're just altogether new, and justify building this expertise in going in and doing these investments, especially if they are direct investments, which institutional investors, in tendency don't do that often, but increasingly so. And in particular, however, it's these deal flow can also help help a flow of securitized products here. So that's to help on the demand side of these flows of funds into infrastructure. If you want to, Ayush just pointed out, securitized products are important, particularly for asset managers to invest as a channel to invest into infrastructure, and particularly to green infrastructure. But to have a securitized product, you need projects to securitize. You need projects in that securitized product. And this can, as we said, generally help to mobilize asset managers in particular, but institutional investors in general, to take whatever is securitized here on their balance sheet and free up the space on balance sheets of the banks that financed that before, the project developers. And additionally to that, having additional securitized products would help, could hitch onto two developments that we see recently. The increase of passive investment, which would be furthered by having more securitized products that could enter these indices or these ETFs, and the recent trends from defined benefit to defined contribution pension funds, where the single pensioner or future pensioner makes their own decisions and therefore would be able to look at investments at their single individual scale, because securitized products can be sold in really small units. So there are two ways to, or there are multiple ways to, for securitized products to help mobilize institutional investment. And as a third area here, I quickly want to mention, but I don't want to stay on this too long, is the role of the investors themselves, which could of course include a public investor as well, so a public pension fund, for example. So in that sense, you still have the policymaker included here. And what could be done on that side would be partnerships, and that includes public-private partnerships, but it can be purely private partnerships as well, which is something that we see, for example, in Denmark, where pension funds have come together to be able to invest at scale. Particularly in some regions like Japan, the second thing that investors here can do is have a selection of consultants that is biased towards green investments. And the third thing is just generally for asset owners to set mandates that already include the mandate to invest in green infrastructure and not just in infrastructure in general as an asset class. So that's a rough overview over the policy recommendations coming out of our report. And of course, now that we have this wonderful database, wonderfully granular database, we will continue working on this. I usually could change slides. And just as a small outlook, what we plan to do is to do country diagnostics. You will have noticed that we only aggregated at the regional level, but of course we have data even at the firm and asset level. So we can aggregate also at a smaller level than region. We can go to the country level, look into particular countries, and the core of that project would be to look into empirical mapping, to look into the empirics to map investments by institutional investors of that country, and to of course look into how much we can even expect at a regulatory maximum of these investors these institutional investors to invest. Of course, secondly, also we will report on the progress by updating the data that we currently have. We plan to have that ready by 2022, and this data also allows us to look into particular sectors. So we planned on sectoral deep dives, possibly not for all sectors, but some juicy sectors we'll take out and do deep dives on. And with that, thank you very much, and back to Rob, I think, and looking forward to your questions.
Thanks very much, Dirk and Ayush, for that very interesting study, and looking forward to getting to some of these questions. But first, we want to hear from our discussants. So I would like to introduce our first discussant. Her name is Hanna Jersild. She is Chief Advisor with the Danish Ministry of Climate, Energy and Utilities, and she will provide a brief intervention on the activities of the Climate Investment Coalition and the Danish government's role in that coalition. Hanna, over to you.
Thank you very much, Rob, for this introduction, and thank you to the OECD team for this very interesting presentation of your new report. I'm sure that this analytical work will contribute to highlighting both the potential and the challenges of increasing institutional investment in green infrastructure. Thank you also for the opportunity to provide some comments and some examples on how the Danish government works with institutional investment mobilization in green infrastructure and climate. The next decade will be decisive for our chances to limit global temperature rise to 1.5 degrees and the impacts of climate change. And as Rob just pointed out, we are far from actually the required investment level, and private investments, including from institutional investors, will be key both when it comes to national and global acceleration of the green transition. To mobilize private investments, governments have to help mitigate mitigate investor risks by creating the right framework conditions for green infrastructure. And private investors have to learn from each other when it comes to business and financial models for large-scale green investments. In Denmark, in 2019, the government established 13 climate partnerships with all sectors of the Danish business community, including the financial sector, to get their input on how to achieve the national climate target of a 70% emissions reduction by 2030. Another initiative is the creation of the Climate Investment Coalition, which you just mentioned, Rob, together with Insurance and Pension Denmark, the Institutional Investors Group on Climate Change, and the World Climate Foundation. And the Climate Investment Coalition aims to mobilize increased private green investments globally towards 2030 in order to raise the global climate ambition and facilitate a green recovery. In the run-up to COP26, the coalition wants to send the double message that private capital is available if governments set ambitious clean energy targets and create the necessary framework conditions. This is why an important part of the coalition's work is to facilitate the dialogue and the sharing of best practices on the building blocks for increased investments in clean energy and in green infrastructure. Another is to demonstrate that these investments are actually being carried out in real life right now. At the UN Climate Summit in New York in 2019, Danish pension funds announced the ambition to invest some $50 billion in the green transition between 2020 and 2030. And in November 2020, at the Climate Investment Summit held by the coalition, Insurance and Pension Denmark could actually report that Danish pension funds have increased their investments, their green investments, by $8 billion already in the first year. This is very good news, and hopefully this can contribute to inspire other institutional investors as well to invest more in this important field. Thank you again for your attention, and back to you, Rob. I think this was my words right now.
That's great. Hannah, thank you very much for those comments. And what stands out to me, I think, is the relationship between your initiative, this Climate Investment Coalition, and this report, in that what your Danish pension funds are showing is that this investment is possible today. And often in these discussions, it doesn't get down to the level, well, how is it actually happening? In what countries, through what channels, in what infrastructure, and so on. And that's what our report provides at a granular level, giving an idea of through what instruments, and also partnerships too, that this is happening. So it's good to see that Danish pension funds are setting the example for others, and that Denmark is once again punching above its weight, a small country that nonetheless is very active in this space. So thank you, Hannah. Now I'd like to turn to our second discussant, that is Daisy Streetfield. Daisy is Program Director with the Institutional Investors Group on Climate Change, IIGCC, and she's going to discuss their Paris-aligned investment initiative and there's net zero investment framework. So Daisy, if you're there, please go ahead.
Thank you, Rob, and thanks for having me come and just say a few words today, and congratulations on the report. It was really interesting, and I'll perhaps offer a couple of reflections of the points that jumped out at me towards the end of my remarks. But yeah, just to start with the work that IIGCC does, supporting our members, primarily asset owners and managers across Europe, to take action on climate change, and that includes thinking about how they align their portfolios to the goals of the Paris Agreement, which we've been doing through our Paris-aligned investment initiative, and increasing their investment in green investments in climate solutions. And we've worked closely via the Climate Investment Coalition to encourage action in that regard. And I think green infrastructure is really an important theme in both of these areas. And this is a very timely moment because we are just beginning our phase 2 work on the net zero investment framework to incorporate infrastructure as an asset class and look at how you can decarbonize a portfolio in infrastructure and invest more in green infrastructure as part of that work, building on the work we did last year to develop the framework for 4 other asset classes. And I think through that work, what we're trying to do is provide a framework that guides investors to be able to both measure how aligned their portfolio is with the net zero goal by 2050 to achieve that 1.5 degrees limit, and also how aligned the underlying assets within their portfolio are through kind of having standard approaches for methodologies and metrics for measuring that alignment. And that does include both the question of the carbon footprint and forward-looking carbon performance of those potential assets, as well as the kind of investment in green. I think we're all well aware that we need investment at a scale sort of unprecedented in certain kinds of technologies, and kind of green infrastructure, and some of the sectors within that are really key to that effort. And I think it didn't surprise me that in your report you noted that 79% of investors are looking to increase their allocations to infrastructure. I think that's partly around yield and some of those challenges for investors, but I think certainly when investors are looking at green and climate, the kind of green infrastructure space is really critical to being able to kind of achieve those goals. And so that is, I think, also driving an interest in green infrastructure, and that is a sort of almost an asset class in its own right when investors are thinking about alignment of their portfolios. I think there's lots of interesting things that are sort of barriers and opportunities there, however, and the report kind of gets to some of those issues. I was very interested to see the focus in terms of how you invest in infrastructure, mention sort of greening mandates, the mandates that asset owners set for their asset managers and the requirements are a key driver. And we pick up on it more generally in the net zero investment framework as one of the sort of top level governance actions that asset owners need to put in place is really setting those objectives and mandates for their asset managers, because once they do that, the managers will understand there is money to be made in offering those products, developing those funds, identifying those assets, and that virtuous circle of encouraging the project pipeline, the investment opportunities is driven from that. And I think some of the things you mentioned also in terms of overcoming those barriers to that scaling up are key. So I think there's really interesting work to be done on scaling and securitization. We often think about green infrastructure as sort of the really big scale projects, the large offshore wind farms, etc. There's an awful lot that needs to be done in terms of green urban infrastructure and infrastructure at potentially a much smaller scale. And access for institutional investors certainly to those kind of products will only really come through securitization and those efforts. So again, sort of looking at what is the next frontier in that process, I think is really key if we're going to see that scale up take place. I think there are a few challenges around this, and one of which is, and I think your statistic on that actually only 17% of global infrastructure is private sector infrastructure. Infrastructure is by its nature a public sector business. It is about public services, and so I think there is a sort of hand in hand that has to happen of governments, whether national or local, planning their services and infrastructure and expectations around green, to then have those things that investors can invest in. There's a certain amount they can do, and we'll look at this as part of our framework in terms of managing infrastructure that exists in a way that is more green and achieving decarbonisation. But ultimately, all that new infrastructure needs to be planned and built with the kind of net zero goals in mind. And I think governments have a key role in that. So those two things go hand in hand. I also think, and it's the final sort of challenge perhaps I'll pick up on, which you mentioned a little bit, is the way that investors are now investing. And I think one of the trends we see is a sort of a low fee environment where passive investing is sort of often preferred. And I think it perhaps goes against some of the things that need to be done that have probably a more active approach needed for green infrastructure and thinking about how you access those products, and potentially that kind of low fee environment that we're in runs counter a little bit to the innovation that is needed in this space. So I think there are some ongoing barriers, but also some good progress, and we're hoping to drive that kind of progress, including on things like greening mandates through our net zero investment framework, and as our members start to implement that. But I think this report is very timely in this session to inform our work that we're taking forward on infrastructure, and yeah, lots to dig into in that, and I'll leave it there for now. I've probably gone over my 3 minutes, Rob.
That's quite all right, Daisy. Thanks very much for those comments. Very well taken. Let's make sure that I'm not muted. I'm not good. Just a couple of things I guess I would react to. First, the role of governments. So this report, as you can probably intuit in the slide that Dirk was covering with the sort of the complex diagram of different policy factors and levers. A lot to cover in this presentation. We encourage you to look at the report and sort of try to unpack in the report the different policy elements that need to be considered and that have a role here. One element is on building pipelines, and what is the role of governments in mainstreaming sustainable infrastructure in their infrastructure planning. So Daisy, you mentioned the key role of governments there. So certainly that's an area that we've focused on. You also touched on securitization. And I think before we go to questions from the audience, just to keep Dirk and Ayush on their toes, I'd be interested in seeing what they have to say about securitization, because since they only had 20 minutes to talk, I think they didn't have much time to touch on the key role of securitization, whether it's for asset owners in thinking about how you can get securitized products to private equity vehicles, or to asset managers with vehicles like yield cos that are, to me, very surprising how large yieldcos can be and how efficient an instrument they can be for ramping up investment in these passive vehicles that tend to be favored these days. So if hopefully Dirk and Ayush don't mind my throwing this back to them to comment a bit.
Yeah, thanks, Rob, and thank you for this additional sort of time to touch upon this subject. So there are really these two trends that we can see in the markets. The first, as Daisy mentioned, is this rise in passive investing. And the second is the shift across many jurisdictions from defined benefit plans to defined contribution pension plan, which democratizes the decision making. It really changes the way allocation decisions will be made going forward for vast pools of capital. In that context, we feel that securitization and structured products, both, they're key, and they can be key, because in many countries, we do not have large utility scale projects. The need of the hour is smaller scale projects. So there's this one issue around giving institutional investors the scale that they require for a transaction to become viable. The second is using securitized vehicles like REITs, like infrastructure investment trusts, from two angles. The first is from the angle of the banks, the sponsors, and even the asset owners. In this, by what I mean, public sector asset owners. It gives them an opportunity to monetize their existing assets and free up construction stage capital that can actually take on a higher risk before the longer term investors can move in and shoulder operational projects. The second aspect is using securitized vehicles like REITs and yieldcos to create opportunities for retail investors, including them into the pension offerings, including them into the other different kind of funds and offerings that retail investors have, by virtue of which one can expand the investor base for infrastructure from life insurance companies and defined benefit plans to cast the net much wider. The second aspect is, the other aspect is structured products. And why we feel that there should be focus and it merits more research is many times the risk when it comes to emerging markets, there's a difference between the actual risk and the risk perception when it comes to emerging markets. What structured products can help us do is bridge that risk perception gap, that can bridge that gap so that capital can actually move and overcome that perception that there is higher risk than there actually is. And I will stop there.
Okay, thank you, Ayush. So we have a few questions that have come in. Let's see. Let's start with a definitional question. You received a couple of questions about how, for the purposes of this report, do we define green infrastructure, and then as another question notes that the European Commission defines green infrastructure as green areas crossing suburban and urban areas, but you don't see that in this data. So there are different uses of the term green infrastructure. Can you tell us, Ayush and Dirk, about how you define green infrastructure for the purpose of this report?
I'd like to tackle that second question, if I may. So there are indeed competing definitions of green infrastructure out there. And one is this one that you just mentioned that is used by some papers, at least the European Union. When we talk about green infrastructure, we mean physical infrastructure assets and that are of a particular technology type. So like solar and wind, as you know, I think this is the definition that in the investment space and the finance space is most used for what is mostly meant by green infrastructure. And actually, when you follow up on these definitions, you will find that there is, the strand of literature that's mostly concerned with investment and finance that uses green infrastructure like that. And then there's a strand about how to green an urban landscape that uses that other definition. But here we strictly adhere to a physical asset that is aligned with climate objectives.
And if I could just add, so for the purposes of the report, we took a practical lowest common denominator approach. What we did was, and the starting point was acknowledging that there are competing definitions. So what we did was we took green bond standards, taxonomy, guidelines in major jurisdictions under study. And we put them next to each other. And we mapped out the sectors that qualify as unequivocally green. And that gives us, and that is the core definition of green here. It's interesting that we mentioned the EU taxonomy, because the EU taxonomy, which is, if I can say, the most advanced of the documents that we studied, has a certain conditionality. It has, for certain technologies, certain sectors, it considers them green only if a certain condition, like an emission threshold, is met. Given the scope of the data and given the scope of the jurisdiction under study, we did not test for that conditionality. And so we assumed that in any jurisdiction, if there is a condition to be met for an asset to be green, that condition is met. So the 340 billion, the amount, or the 30% of overall infrastructure assets that we allocate or classify as green, must be seen as an upper bound.
Okay, thank you both for that. So we took a practical, as to paraphrase, took a practical approach, recognizing that there are several definitions out there, and taking a look at what's in common among these different definitions. We're not trying to litigate the tricky question of what is green and what is not. Of course, other parts of our work do look at that question, and we had a report on sustainable finance taxonomies and definitions that was issued last year on October, where we compare official definitions in 5 different jurisdictions. Here, for the purpose of this data collection and analysis exercise, we took a practical approach to get what we think is a reasonable assessment of what is green. But again, it's probably an upper bound because of these conditions that we couldn't check. So let's see, another question. Okay, this didn't come up in the work so much, but it does link to our work on policy. How governments plan to incentivize investments in infrastructure. So again, not a topic of the report directly, but certainly very relevant when we think about private initiatives in this area. Who wants to try to tackle that one?
So I think there are, thank you for the question, by the way, and for the earlier one as well. I think there are many policy levers we can talk about, especially when we go beyond institutional investors. But I think the pivotal point here is to go back to what I talked about earlier when it comes to pipelines. This report we have on pipelines, on the one hand, it shows how generally to build these pipelines, transfer the government's objectives into plans, and then transfer that into other stages of the project planning until it's clear which project will be there and if that will be enough to meet objectives or not. And in that report, you've also find a few levers that governments can pull to, as I said earlier, build markets. So we also have another line of work on these risk mitigants and transaction enablers, where we analyze a database full of projects where these risk mitigants are used to incentivize private investment, including institutional investment. And these risk mitigants could be just a plain loan given or a loan guarantee, but it could also be more complicated types of warehousing and then bundling this into a green bond, for example. So there are multiple ways that public financial institutions and also the other arms of the government can use. And I'll stop here, I think. Otherwise, I'll talk for now.
Ayush, did you want to add something?
Maybe just one sentence to add to that. Another way that we can create markets and incentivize investment in infrastructure is through institutional innovation. So whether it be green investment banks and their role in creating markets. And there's a great example of the New York Investment Bank that actually very actively looks to provide syndicated financing, refinancing for projects to create, and this idea of recycling of limited capital. or you can have green windows in existing development institutions to leverage their niche capacity to green certain sectors, as we see in some emerging economies, or we can have this new a hybrid between the sovereign wealth fund and with a more active mandate coming into play, what is termed as the strategic investment funds, like you see the NIIF in India, which has a more active mandate sort of to crowd in foreign investment, but also handhold them with local knowledge and expertise, while providing a sort of active risk mitigation and warehousing and other kind of capabilities.
Okay, thank you both. And there could be a related discussion here on why institutional investors are motivated to invest in this area. And so this gets into topics that Daisy and Hannah think about daily. Risk assessment through the reporting under the Task Force for Climate-Related Financial Disclosure, increasing disclosure and analysis of these risks, but also interest in being aligned with a net zero target, for example, interest in being seen as being a pioneer in investing in green infrastructure today. But that's somewhat different from the question about what can governments do to incentivize. And I think that this is an interesting question that we can take forward in our work. A different question, how do we want to coordinate between stakeholders based on this data going forward? How do we want to coordinate with different actors and stakeholders taking differences in national capacities in mind? So Dirk and Ayush, I guess I'd reframing this a little bit. What do we want to do with this data? What actors do we want to work with, and how can it be used?
I could probably start with it, and Dirk perhaps would have things to add. So just from the very outset, there's a clear and what we see between, of course, when it comes to infrastructure planning and procurement, as we've mentioned in this report in 2018, but also the 6 elements that you see on that chart under the pipeline planning and procurement side, there's the need for multiple ministries that are involved to come together and work together. And then there's a clear need for the planning and procurement side to work with the financial authorities and regulation if one is to move in the direction of using financial policy and innovation to create more products and deepen the markets for this. Then there's definite need to work with the public and the private sector. So there's an interesting initiative that we mention as an example of this public-private initiative in the report, where you have in the insurance sector, the general insurers working now with the governments to create products that from the very outset insure public assets, because while private assets are insured, public assets are often not. And while life insurers invest in infrastructure, it is the general insurers that insure the asset. So sort of bringing together those various pieces of the ecosystem to come to the same table to develop and plug in the gaps that can put public and private infrastructure on the same footing.
Not much to add there, but just to emphasize bringing the pieces together. You know, once you have a granular data set, that's what we are proposing basically with these country diagnostics. It would be easy to pick out which investors invest where, and try to and find patterns of which types of investors or through which types of instruments these investments are made, and then bring them together. That can be done under one country's flag. One country could go and look, and which of their investors invest where, or which investors invest in that particular country. But it could also be done as part of a coalition of either countries or investors.
Okay, thank you both. I guess I would add there for a donor country that's interested in mobilizing its institutional investors, it's interesting to consider where their institutional investors are currently investing in infrastructure. Obviously, the question about green versus non-green and geographically, where is that investment going? Now we got an interesting and maybe tough question, and I'm going to give this to Dirk. The question is, on the infrastructure side, in which sectors and stages of project development have you identified the largest investment gaps?
Well, that indeed is a hard question, partly because then for that you would need to identify the needs in particular sectors and stages. I mean, what is clear that, and so what I'm saying is I can't give a straightforward answer to that, since you would have to identify the needs. What is clear, however, is that there are particular countries and country groups where there are needs. I mean, there's a reason why we emphasize the cross-border work, so the cross-border empirics, because the group of emerging countries is where most of these investments will need to be made, and therefore we want most of that to be green too, right? Because most of that is also new investments in new infrastructure. Having said that, while we're talking about sectors and stages, the report also, and we haven't had that on the slides, but the report also shows that, and to some people somewhat counterintuitively, institutional investors are interested not only in one stage. You would think that secondary stage is mostly what they invest in, but the gaps that are there in the primary stages would also be a target for institutional investors. And if you look across the instruments that we looked at, for example, in project debt, we find that direct debt investment into projects by institutional investors, it's almost half of these investments are made in the primary stage. So when these gaps are identified, whichever stage they are, institutional investors are relevant.
Thanks, Dirk. And one area where you may recall when we were talking about the Fast Infra initiative for labeling infrastructure was this exercise where we estimated where the investment gaps were. And as I recall, transportation, there was a particularly strong investment gap in that area. Now, it wasn't the purpose, and this is a question from Dominic. Dominic, it wasn't the purpose of this study to estimate the investment gap, just to sort of get a current, very granular take on where investment is undertaken. However, the OECD estimates that each year, approximately $6.9 trillion US in sustainable infrastructure investment is needed. We were looking at transportation in particular, and that was a very large gap. So I don't want to be quoted on that, maybe in the area of 3 trillion, but Dirk, you'll correct me quickly. He's raising his eyebrows, so don't quote me, but very, very large. And please feel free to follow up with me on that. Let's see, I think we're going to take one more question and they're going to have to wrap up. So there is a question about whether we took into account nature-based solutions. It's another sort of definitional question, but an important one, because this gets at, first of all, there's a lot of attention to nature-based solutions now. OECD is working on this. A lot of attention, increasing attention to biodiversity risks, and our colleague Geraldine Ong is taking the lead with Katya Karasakis on this topic. But if you can just indicate whether nature-based solutions are considered in this analysis, and if not, why is that?
I mean, the straight answer to that is no, it isn't. But the reason for that is because, as I mentioned previously, we took this comparative approach where we looked at the green bond guidelines or definitions of standards issued or in vogue in the countries that we could find under study. And in none of those have nature-based solutions or assets that qualify as infrastructure and nature-based solutions in any of those instruments. So that's the reason why they were not considered. But going forward, that, as you mentioned, Rob, there is we're considering it, and there is debate and discussion about how to integrate it within the existing framework. So we might, in the future iteration, be able to include it, but that remains a question to be seen. But since I have the floor, just to add to what you were saying previously, since I didn't want to interject, one area in infrastructure development where there is a definite gap is, of course, the construction stage, but it is project preparation. There is a clear gap and a need to finance project preparation to originate bankable projects, because while a lot of projects do get proposed, a vast majority of them get shelved at the preparation stage. So there is a need for actively quality assessment, feasibility, pre-feasibility studies to make sure that at the very outset we are originating investment grade projects that can then be taken up by the market. Thanks.
Great, thanks, Ayush. So we're out of time. We had to start a little bit late because of a glitch, so we went over a little bit. But thanks for sticking with us. I'd like to thank our presenters, Dirk and Ayush, our discussants, Hannah and Daisy. Thanks very much. And all of the participants for a great discussion. We strongly encourage you to visit the Data Explorer website, and hopefully you can find that in the chat. So before you leave, take a look and put that down in your browser, because it's definitely worth a look. You can see graphics and answers tailored to specific questions. It's very user-friendly, and there's a wealth of information available. With that, many thanks for joining OECD Green Talks Live, and have a great rest of the day. Thanks.